Hello friends, Chris Lee CPA here, back with another video for you. So today we're going to talk about if a husband and wife activity, business activity or rental activity needs to file a partnership return. Okay, so there's kind of a misconception out there, when, how, why do husband and wives need to file a partnership return? And so we're going to walk through that so that we can know when a partnership filing exists. So at a foundational level, when a husband and wife co-own property, that is, and to say co-own property, that's kind of like you co-own real estate, that itself does not create a partnership. Basically, there's a special rules for owners of real estate. But it applies to all taxpayers. So when two or more individuals co-own property, their activity rises to the level of a separate entity for tax purposes. That is a partnership only if they carry on a business together. So a partnership exists where there's, economic benefits to the individual participants that do not derive solely from their co-ownership of the property, but rather come from their joint relationship toward a common goal. Okay, so basically, we've got regulations that say, maintaining, repairing, and leasing does not constitute a separate entity for federal income tax purposes. So these regulations are almost verbatim. So it's an example of an activity that does not constitute a separate tax entity. Tenants in common of farm property lease it to a farmer for cash rental or share crops. It's kind of like the example right there. But this rule applies only to individuals that co-own real property as tenants in common and equally apply to business entities. So when spouses or other individuals form a multi-member LLC that owns real estate, so it's not co-ownership of natural persons owning rental real estate, you've got an LLC owning rental real estate that goes beyond mere co-ownership. They have created a separate entity for tax purposes. So yeah, that's kind of what we're looking at. When you have an LLC that's one member, it's treated as disregarded. When you have an LLC with multiple members, it's treated as regarded for tax purposes and creates a tax filing responsibility. So a husband and wife can avoid a partnership return filing if they take title of a rental property individually as tenants in common. So most married couples take title as joint tenants, not tenants in common. So but they have the option of being tenants in common instead. The only difference between joint tenancy and tenancy in common in titling a property is that joint tenancy comes with a right of survivorship. That is to say, title of the property will automatically pass to the surviving spouse when one spouse dies. Okay, so when it comes to the scenario of co-owning a rental property, you can avoid a partnership return filing by electing a qualified joint venture status. And so basically a husband and wife that co-own rental properties will say on one single rental activity schedule attached to their 1040, a Schedule E, they will check a qualified joint venture box on the return. And so, to qualify for this, they must be the only owners of the property, file a joint tax return, both elect not to be a partnership, and both materially participate in the rental activity. That's the last part that's going to be kind of difficult. Usually there's one spouse that materially participates and another one that might not. Material participation is determined by the same rules, whether or not real estate owners are real estate professionals for tax purposes, and avoiding quote unquote the passive activity loss rules. So this means that each spouse must be involved in their business's day-to-day operations on a regular basis, and it's got to be continuous and substantial. So working more than 500 hours a year in the business is one way that meets that requirement, but many couples fail to meet that material participation requirement for both spouses. So that's kind of the thing we need to know about co-ownership of property. Now, when it comes to an LLC, like we said a couple minutes ago, the LLC co-ownership of property through an LLC with multiple members, even if they're husband or wife, defaults to a partnership status for tax purposes. Okay. Now, there are two exceptions to this. One's more commonly known and is kind of more limited in application. Second one is, I would say, describe it as rarely known. So the first is community property estates. So basically, spouses in community property estates may treat their rental activity either as a sole proprietorship, kind of technically a disregarded entity, or as a partnership. If you choose the sole proprietorship status, then they're going to file a rental income and expense schedule on Schedule E, which attaches to their 1040. So to do this, they just need to elect the status in the fact that they file one Schedule E for the rental activity that's co-owned. So they don't need to elect a joint venture status to avoid a partnership term. And this rule applies even if the property is owned through an LLC, right? So that's like one of the backwards things in the community property states. Lots of nuances in community property states, but even if they co-own real estate through an LLC, in a community property state, they can still elect this kind of disregarded entity status. Now, it's important to note that this property needs to be treated as community property. So when it comes to community property states, you have community property, commingled assets of the marital union, and then you've got separate assets. How you determine this is quite the process. Usually assets that exist before the marriage that never come into joint accounts, joint title, anything like that are separate. Anything that gets commingled during the marriage becomes community. Anyway, so that's the idea here, is that if you own real estate in a community property state, the real estate's it's co-owned and it's treated as community property asset, you can elect basically a disregarded entity status. This only applies, again, community property states, which are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. So if you're not in those states, this doesn't work for you. Now, the second one is much less well known. So this is if you own real estate through an LLC and the co-owners are husband and wife, and it is titled as tenants by entirety. So that's to say it is owned by a husband and wife in entirety. The LLC interests that own the real estate property are owned as tenants by entirety. What happens with tenants by entirety, it's fundamentally at the state law level, it's saying that this property can't be owned without the two of them. Together, this real estate interest is this real estate LLC interest. There's no single owner, it's an entirety by the two together. And so that is to say there's one owner for legal purposes. They're not separate owners, they are one owner. You can't separate the two on paper. So tenants by entirety is an exception that people don't talk about. Now, one thing about tenants by entirety is that not necessarily every state lets you title an LLC interest as tenants by entirety. So you have to check with kind of an attorney within your state. But tenants by entirety is a pretty good option for you if you're looking to avoid a partnership filing. Now, there are other things you have to consider, for economic purposes that you probably, economic and legal purposes. I would maybe change the calculus in your specific state. This would have to do with creditors, how properties transfer through estate or probate issues, that sort of thing. But tenants by entirety basically treat as one owner, and that one owner is indivisible, unable to be divided from each other. And so because for legal purposes, it's got one owner, this husband and wife couple, then for tax purposes, it also will have one owner, and one owner of an LLC is a disregarded entity. So that is one of the major exceptions that you will see, or not, I wouldn't call it a major exception because most people don't know about it, but it is an option for you. So that's kind of something to explore if you're looking to avoid a partnership filing but hold rental real estate. in an LLC that's owned by a husband and wife. The real estate LLC does a good job of giving some amount of legal liability protection, but it does come potentially at the cost of more compliance fees to make that happen. So if you've got rental real estate in an LLC umbrella and you don't meet the community property state exception, and you don't have the LLC interests titled as tenants by entirety for legal purposes, then you must file a partnership for the rental activity. So a partnership tax filing is a 1065, and each partner gets a K1. A K1 spits out the income that gets reported on the 1040s. And it all ends up on Schedule E, but rather than a rental and expense on page 1, it's just kind of a lump sum on page 2. So really, the limited liability provided in owning rental property through a multi-member LLC comes really at a price unless you meet some of the exceptions. So unless you're in a community property state or you have the tenants by entirety option at your disposal, you'll have to file a tax return. So that's basically what it is. So key takeaways: co-ownership of a rental property by spouses as tenants in common does not constitute a partnership for tax purposes if all they do is maintain and rent the property. The rules don't apply. That exception for outlined in the IRS regulations does not apply if that rental property is owned by an LLC or so that's when we have to start looking at our other exceptions. Spouses that co-own real estate and materially participate without an LLC can elect a qualified joint venture status and file a Schedule E on their joint file tax return. So spouses in community property states that own a rental real estate LLC that is treated as community property can also elect basically a joint venture status for them as well. But that's only community property states. And our third exception to a partnership filing is going to be that tenants by entirety. So owning the real estate LLC's interests, husband and wife, as tenants by entirety. This is a less common exception, but it is a question that's worth asking an attorney within your state of, hey, can my rental LLC be titled, the LLC interest be titled as tenants by entirety to the spouses together. So then for a legal purpose, because at the state law level, for legal purposes, you've got one owner. Then for tax purposes, it's also going to be one owner. Then it's a disregarded entity as an LLC, and it's going to file a Schedule E the same way that it would if it was the community property exception. So if that's not the case, rental real estate or some other activity by a husband and wife that goes on within an LLC gets taxed as a partnership. So unless you make some other sort of election to be an S-Corp or a C-Corp or what have you. But that's the lay of the land. That's kind of where we're at when it comes to LLCs that are owned by husbands and wives. And so with that, if you've got any direct questions, my link will be in the bio, and talk soon with another video. Take care. Bye-bye.